Coke continues to prove it's in growth mode right now. It's clear from the 6% organic growth. There's a caveat, though, with that number. There's some funky timing issues skewing results this quarter. CEO James Quincy told me to think about it really as a 5% organic growth number. Wilfred, you'll love this. It's Brexit's fault. Remember, March 29th was supposed to be the deadline for the UK to crash out of the EU if they couldn't come up with a deal. Well, Coke overprepared for that scenario. They stockpiled cases. They manufacture in Ireland, and they ship through the UK, actually, to Europe as a transport route. They may have to rethink that depending on any deal. So they were left with more inventory. As for the actual business, here's some highlights. Coke launched the new Orange Vanilla Coke this quarter. Quincy told me it did very well. Coke Zero continues to grow double digits, especially doing well here in the U.S. As for those new Diet Coke flavors launched this year, strawberry guava and blueberry acai, Quincy says they did okay. Didn't quite get the same excitement as Coca-Cola saw when they first launched new flavors last year. Another bright spot, China and India continue to show growth despite all sorts of fears of a slowdown. So overall, the quarter painted a balanced picture of growth on volume and on higher pricing. And then finally, guys, what Quincy called the downer of the year, got to mention it for this company, currency. It shaved 11 points off of that bottom line because of the strong dollar. But importantly, Quincy did tell me this is the worst quarter of the year for a Forex hit, so it should get better. We're going to talk a lot more about all these issues with him at 10 o'clock. He joins us first on CNBC. But remember, Wilfred, Andrew, and Becky, last quarter, Coca-Cola was actually a big disappointment because of the guidance number. It was all due to a strong dollar. Today, we got a real taste of why they are feeling that so hard with that big hit to foreign exchange. By the way, they kept the outlook unchanged.
Sarah, Brexit and currency, there's something in there for both of us. But what about Procter & Gamble this morning as well, which I know you look at, and the fact that these staples companies, Kimberly-Clark yesterday, they're kind of doing pretty well.
They're doing well, and we've seen that reflected in the market. So last year, consumer staples really underperformed. I think they were down 11% or so, worse than the overall market. So far this year, they're still underperforming the market, but they're doing much better than some of the other traditional defensive groups, like healthcare, for instance, up about 12, 13%. I think it's a combination of two factors. One, they are considered safe always, and the international picture has brightened a little bit this quarter. A lot of these companies are internationally exposed, but also you've really seen them turn up growth a notch. And I would point to a few specific companies. Procter & Gamble and Coca-Cola are two really good examples of that. They've got new leadership in place. Execution is thought to be very good, according to Wall Street analysts. There's some new innovation, as I mentioned. I think I would point to Pepsi as well. And Kimberly-Clark yesterday, whose stock shot up because they are implementing those price increases better. So you've got a few specific examples that Wall Street is really attracted to, not only the safety play and the cash flows and the dividends, but also higher growth, which is something that took years for some of these companies to achieve.